You have to understand that there's going to be three main segments that you're going to always deal with money accumulation, distributions, that you're going to always be in throughout your entire lifetime. Whether you're not in some earlier on and you get into those certain categories later on in life, you're ultimately, by the time you're ready to accumulate, ready to retire, you will be in all three stages. The first stage. Now, this could be a different story for everyone. It all kind of depends. When you're younger and you decide, okay, I'm younger, I could be I could be a teenager, whatever it is, and you want to start saving money, you understand the importance of, you know what, everybody has a bank account, I need to have a bank account as well. Rather than just leave money in cash, leave money in your dresser drawer, you're going to go and, however old you were, you went to the bank with your parents and you opened up something called a junior savings account. This is the savings stage. It's typically dealt with in banks. Now what happens is during that stage you put money away just to kind of hold it into a bank. The whole purpose of this money is for emergencies, if you ever needed it to buy candy or whatever it was in that, while you were younger. People have 3 to 6 months that they have in their savings. This is short term and just for safety and liquidity. And the return is almost irrelevant. You understand that you can't necessarily put money into a bank and then that's what you're going to retire off of. So this is typically the first stage that you're ever going to be introduced to as a child. Now what happens? You go away to college, or right from high school you go and you obtain a job. And you understand that you're not just making $10 a week from your allowance, but now you're starting to make substantially more money, and now you start to buy a car, you start to buy a house, whatever it is, but you understand that you want to start accumulating some wealth. So it brings us to stage number 2. What happens is, throughout time, people gear a lot of their investments and a lot of their accumulation towards the stock market. And that's why we have number 2 as the stage of investments. You have the stage of risk versus return. So if you're bringing in a paycheck, you understand, okay, X amount is going to be placed for my expenses, and anything discretionary, I'll start placing that towards a fund for retirement. Now, the different employers, they have different funds out there, hence a 401k, a 403b, where they kind of force you to start saving for retirement. They say, hey, we give you X amount of match, put some money over here, and they kind of use it as an incentivized program to keep you with the company. But ultimately what it is they're investing your money throughout the stock market, a mixture of stocks, bonds, mutual funds. You could get with, you could go into exchange traded funds, real estate investment trusts, options, commodities. There's a whole slew of it. Ultimately what this means is this is just the growth stage. You do have your risk, you do have your return. Obviously the riskier the investment, the higher the rate of return can possibly be. Now, you ultimately want to always have more risk when you're younger, to say, you know what, I'll take a couple of those bumps in the road to understand that long time horizon, if the market typically goes up, then I'll be able to make it out on the back end. And then once you start becoming 40, 50, 60 years old, you're going to be more and more conservative, more into fixed products. So we have stage 1 and stage 2, and you're not just gonna take your money at a stage 1 and just place it all in stage 2. You're going to diversify that properly. So once again, just to reiterate, we have stage 2, you could make money, you could lose money, and it's comprised of stocks, bonds, mutual funds, ETFs, real estate investment trusts, options, commodities, and the number 1 priority is for growth and accumulation, to one day become financially dependent. You understand that this is going to be your safety, your savings, and this is going to be your short-term money. This is going to be your emergencies. This is going to be your 3 to 6 months. If something happens, a tree comes and falls through your house, you understand that you could take money for that. Your children need braces, you could take money from your savings. Now what happens is, because the way that this money grows in some different various retirement accounts, it grows along a tax-deferred realm, meaning that they're going to give you that advantage of tax-deferred and the power of compound interest. But if you try to touch this money, you could become heavily penalized. So it's mainly set up for a growth stage. To one day have this bucket grow, and then when it comes time for retirement, you start your distributions. Which brings us all the way to stage 3, income and preservation. Now this is typically, the income and preservation stage is typically insurance companies. In stage 1 we had banks. In stage 2 this is brokerage houses, mutual fund companies, typically the Wall Street. They control stage 2, so they control the mutual funds, they control your growth, they have the financial gurus, the sub-account, the fund managers, all those people will be in stage 2. Stage 3 is going to be with the insurance companies. So a lot of these companies, they offer you lifetime income, contractual guarantees through guaranteed insurance contracts. Some of these examples could be immediate annuities, it could be certain products with income riders, and it could also be pension plans. Now, this is how it was supposed to be. You go from stage 1 to stage 2 to stage 3, but you never leave all 3 stages. You're always going to have a truly diversified, complete portfolio is going to have money in all 3 stages. There was something that happened with the stock market that flawed the perception of everyday investors' minds. And what happened was in the 1980s, the market growth altered the perception of large gains with no risk. We understand, and there's some videos that I constantly touch base with that state from 1980 to 2000, we had the largest market growth in the history of our stock market. It grew upwards of 1,000% gains. So that means anything that you were placing into the market was making you money. Everything was working perfectly. But as we know, in these past 12 years of this bearish cycle that we've been having, it's not guaranteed. So when you had all these large gains, people just thought, as long as I keep putting money in there, there's no risk. So that's where the 4% rule came out. What happened was the stage of the investments, the brokerage houses said, hey, we're giving you all this money. I mean, come on, you've been with us for 10, 20 years. We're making you all this money. You don't need to go to the income and preservation stage. We're fine. Come on, 80s and 90s, this is 20 years. Your money's never going to lose. You know this. I mean, we can't guarantee that, but you know we're pretty good at what we do. So why don't you bring your money over here, and we'll create this industry-wide formula called the 4% rule, which it keeps your money in a traditional balanced portfolio, 50% stocks, 50% bonds, and you could take roughly about 4% a year, and that should last you throughout your lifetime. About 25 years is a 90% chance that that's going to last you. Now, what we learned in the other videos that T. Rowe Price performed that study from the markets of 2000 to 2011, and rather than a 90% chance that that money's going to outlive you, because the markets have been so beat up, and the bad fiscal policies and the economic deficit, that there's only a 6% chance that that works. So we have to start becoming smarter and understanding we have to implement the income and preservation stage. We have to at least have some of the contractual guarantees. Now that doesn't mean all of your money. That means whatever your expenses are, we use a formula of laddering strategies to make sure that this is covered, and this is covered, that we're never just putting it all in one spot, because we understand with the banks, the return is almost irrelevant. You're going to be beat up with inflation. You have to have some of the stage of investments. We understand with the stage of investments that the downfall to it is it's not guaranteed. There's a lot of risk that's associated there. And we understand with the income and preservation, yes, that maximizes income distributions, but a lot of people like to have a little bit more of the risk. We want to make sure with this income and preservation stage that you're at least covering your bases. You're at least tackling the most important aspects through your lifetime. So this is the 3 stages of money. Please view the 3 money worlds. It correlates a lot to this as well. You can find that in the retiree section. Once again, my name is Derek Ifasi. The name of the website is retiresharp.com, and that's essentially what we want you to do. We want you to retire sharp at all angles. We never want you to guess again. We want you to understand what is out there and kind of why the mindset of retirees has been essentially flawed, and how to kind of get back on pace, and to understand sequential income planning systems. You need to have a plan in place. It's not good enough to just guess again, because the markets are not cooperating, and you have to understand that there is risk versus reward. Once again, my name is Ifasi, owner of Ifasi Financial Group, and I thank you very much for watching this video.